ultimately you make a couple decisions. One is, do you flip public? And of course we did that. I think we did it on June 30th, right before the, July 4th holiday. We did a lot of testing the waters in June and candidly all through the spring. And I think we felt like we were going to have a good reception. And then of course, we started our roadshow the Monday after Donald Trump was shot. During our roadshow on that Friday, the CrowdStrike incident happened. And so we landed in San Francisco after midnight. We couldn't get into our hotel room because, the electronic door locks didn't work. Of course, Joe Biden decided not to run for president again that weekend. And so we're dealing with all this market uncertainty. And then, of course, we priced, and the day that we went public was the worst day on the NASDAQ in 2.5 years.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to the Run the Numbers podcast. I'm your host, CJ, and today, we got a good one for you. We got Bill Koefoed, the CFO of OneStream Software, on the pod. This was a great one. He took us through the entire IPO process. We talk about their Day-One Pop. That stock traded up 34% from $20 to $27 per share on a day that the market was all red, which was amazing. He talks about how they went about building the book of investors and the qualities they prioritized for those investors when they were looking at the mix between long only and hedge funds. We talk about what matters the most in IPO prep out of all the litany of things you have to do and the processes that aged him the most. I'm catching Bill a couple months after their IPO, so he takes us through his learnings now being a public company CFO and navigating those waters. And he gives us the inside scoop, baby. What's a roadshow like? How long did it last? What cities did they hit? Did they listen to any good tunes on the plane? The cool stories that came out of that. And Bill worked at Microsoft. He spent time in their investor relations department, and they're known for having one of the best IR functions globally. He gives us some tips and tricks that we can add to our toolkit when it comes to IR. All this and much, much more after a short word from our sponsors. Annual planning season is upon us. That's right, my favorite time of year. And it's not just about setting goals for the coming year. It's about ensuring you have the right tools in place to measure and achieve those goals. As a SaaS CFO, I know having access to reliable, real-time metrics is crucial for my annual planning process. That's why I'm so excited to partner with today's sponsor, Maxio. Maxio is a billing and financial operations platform that helps subscription businesses reconcile bookings, billings, GAAP revenue, and SaaS metrics automatically. By the way, guys, bookings, billings, GAAP revenue, not the same thing. Got to get them straight. Because these numbers are the foundation of your financial models, it's important to have quick access and trust that they are correct. Don't let the complexities of SaaS finance and accounting slow you down. If you want to start 2025 with the right tools, check out Maxio by visiting maxio.com/run the numbers. That's maxio.com/run the numbers. Request a demo through our link to support the podcast, ya boy, and receive a 10% discount on your first year with Maxio. That's maxio.com/run the numbers. maxio.com/run the numbers. Please, guys, I really need this. Okay, serious question for all my accounting pros here today. Are you doing what you were hired to do? What I mean is, do you have time to actually be a business partner, or are you buried in tedious manual tasks just to get your journal entries prepared every month? I know how that feels. Leapfin's here to help with that. Leapfin is accounting automation software that automatically prepares and posts reliable journal entries. And that's just the beginning. High-growth businesses like Reddit, Canva, and SeatGeek choose Leapfin to eliminate manual tasks, accelerate month-end close, and enable accounting leaders like you to provide faster insights that will help your company grow. If you're battling messy transaction data from Stripe, Adyen, Shopify, Apple Pay, and other PSPs, and then battling again to get it all into NetSuite, go to leapfin.com to watch their short product intro video. And if you like what you see, request a 15-minute conversation to learn how accounting automation can help you and your team. Check out leapfin.com today. That's leap like jump, fin like shark. I just made that up. I hope they're okay with it. Leapfin.com. Well, Bill, as a kid, I used to collect baseball cards. Now, as an adult, I collect S1s, and I'm very proud and honored to have you on the podcast. Thanks for coming.
No, I'm happy to be here. Thanks for including me.
So you did a very brave thing last year. You went public when other companies were not. What was your criteria to pull the trigger and say, let's go, it's the time?
Well, first of all, I'd say it was a little bit scary. There hasn't, to your point, there hasn't been a lot of IPOs over the last 3 years. And, we started thinking about rekindling the S1 back in February when we, kind of closed out the 2023 numbers, and just to kind of be ready. But of course, if y'all remember, in May, Salesforce and Workday both had, tough results, and the market reacted negatively. And so you're looking at it saying, wow, should we start this thing? As you get more toward the June timeline, it was the end of our, fiscal quarter, and we wanted to make sure that the sales team delivered and executed well on that. And then, ultimately you make a couple decisions. One is, do you flip public? And of course, we did that right before, I think we did it on June 30th, right before the, July 4th holiday. And that was a big gulp. But, we did a lot of testing the waters in June and candidly all through the spring. And I think we felt like we were going to have a good reception. And then, of course, we started our roadshow the Monday after Donald Trump was shot. During our roadshow on that Friday, the CrowdStrike incident happened. And so we landed in San Francisco after midnight. We couldn't get into our hotel room because, the electronic door locks didn't work. Of course, Joe Biden decided not to run for president again that weekend. And so we're dealing with all this market uncertainty. And then, of course, we priced, and the day that we went public was the worst day on the NASDAQ in 2.5 years. So it was a roller coaster, but we felt well prepared. And obviously we had a good reception at the end of the day.
I have to applaud you for being honest that there are nerves involved in this, because people look at the numbers and say, this is an amazing company, they're going public, like everything must be, up and to the right, including your emotions. And we're all people at the end of the day behind it.
Yeah, no, it's scary. I mean, you go into every meeting, what are they going to think? Are they going to want to invest? Wow, you're sitting across a table filled with, 25 or 30 investors who are all pretty smart. And it's an incredible journey.
I mean, I guess the flip side of it, is it potentially also a good thing if nobody else is going public? You get more airtime?
We did feel that. I think that's a good point, because to your point, there was nobody else, that was even potentially going public
right
at that point. Candidly, Lineage, which is another non-tech but Michigan company, went public the day after we did, which was kind of fun to see two Michigan companies back to back. But yeah, no, we definitely got a lot of attention from investors, and I think that was definitely a good thing.
And then criteria wise, were there any metrics that you wanted to hit? Did you say, once we get over this threshold in ARR, or we're coming off a quarter of accelerating additions? How did you think about that in terms of readiness?
I think the market really wants people that are profitable or pretty close to being profitable. We were fortunately profitable in calendar 20, we're calendar year end, in calendar 2023. And so we felt really good about that. We knew that we would hit 500 million of ARR, at the end of the second quarter, which we did. So kind of that, I don't know that there's a rule per se, but the kind of profitable 500 million seemed to have been a sweet spot.
Yeah, you were around, I think, 480 in ARR, coming up on 500, and you'd produced close to 50 million in free cash flow. So it's kind of like check on the top line, check on the bottom line.
Yeah, again, we kind of knew we had been going through a SaaS transition over the past 3 years or so, and then of course, the scale that you get when you're 500 million, we knew that we would be cash flow positive, and it just all worked. It kind of coalesced in a nice way for the timing of when we decided to go public.
And when you did go public, you touched upon that day. My goodness, the market was painted red. You were the only green in sight.
The interesting thing about that day, and it's still a little bit emotional, transparently, ringing the bell is fun. You get up there, you get your picture taken, and you get on CNBC, and everybody's families and the like get up there. For me, it wasn't real, because of course you don't start trading until call it 11 o'clock or so, maybe 11:30 Eastern time, depending on how big the IPO is, et cetera. And we didn't do that big of a float. We did about 10% of what our total shares outstanding were. So we were waiting for kind of the supply demand equilibrium to become one that they would actually start trading. And, I remember when both Morgan Stanley, who was our lead left banker, as well as the ECM guy at NASDAQ, called me and said, okay, we're ready to open. And when that first trade happens, CJ, that's when it all kind of comes to light. You're like, everything that we did, all the investor meetings, the pricing meeting that you had the day before, the crazy market that we had no idea how it was going to open up, given that the overall, market and NASDAQ were certainly quite red that day. That's when just, your emotions really pop. And we were we were really happy. We priced at 20 and our first trade was $26, which we were happy about.
I consider myself a fan of SaaS and a fan of business. And as nerdy as it sounds, I was cheering because the market was down. And like you said, people don't realize sometimes that they know the day you IPO, but they don't realize that you're basically waiting till lunchtime to actually trade. So you keep hitting like refresh. And I was pumped when I saw you go from 20 to 26. It was like I was watching an ESPN like scoreboard on my phone.
Yeah. Again, I mean, we were almost, again, as I mentioned, it was quite emotional. And I think even more emotional given how red the screen was. I mean, I think literally 97% of the screen was red that day. And so, having a good first print was, and holding it for the day, I think was pretty, a sign of relief for us.
It was. And can you maybe, for the benefit of listeners, explain how you think about a day one pop? Because it's got to be kind of this counterbalance where it's part art and part science, because you, the company, don't get to keep all the extra proceeds, right? But you do have investors that you want to make happy.
Well, there's been a couple IPOs that have happened over the past couple of years, that we certainly learned from. And candidly, some of the stories that you hear from the banks are a little bit myth, and some of it is reality. I mean, they have their own incentives, and they'll show up with presentations and show them to you and say, here's what these guys did right, or here's what these guys did wrong. I think for us, what we really wanted to do, again, going back a little bit to the beginning of the process, we were really fortunate that T. Rowe Price, who generally never does cover, they wanted to come in for 15% of the total IPO. And we were lucky. I mean, I'm sure we'll talk about this here in a minute, but we had done a lot of investor education with them over the 3 years prior to when we went public. And they really liked our story. We had been really open with them. I think, for those of you who've been following us, we did momentum press releases every quarter. So kind of, it showed our progress over time. And so when you get a name like T. Rowe, that's, they're pretty discerning. And I think we were fortunate to have that. Well, and that led to some other big anchor investments. They weren't on the cover, but they were, kind of some of the most prestigious, either mutual funds, hedge funds, or in some cases, sovereign wealth funds. And so we felt really good about the interest that we were going to have in our stock on day one. Of course, then, we just as a reminder, so we launched at 17 to 19. And then what happens, for those of you who don't, I don't have my phone in front of me, but you have an app that the bankers give you, and it basically has all the orders, and you can follow it. You can go to a meeting and you're like, oh, such and such a fund ended up putting in an order.
No way. So this is actually really interesting. I didn't know they give you an app to track this. This is so cool.
Oh yeah. Well, we had Morgan Stanley and JP Morgan, and they both gave me apps. So then it was like, which one am I following along on my phone that day to see, who's put in an order. And then you'll be, in between meetings, and you'll hear like, oh, such and such a company ended up putting in an order for X number of shares at whatever price. And so, you go to meetings all day, and then you kind of find out how you did. You get a real-time report card, shall we say. And we were lucky. We're 20x oversubscribed. So the numbers of shares that we had, offered in the prospectus, we had, 20 times the number of demand. And so then we talked to the bankers. And at one point during the process, we decided, hey, we're going to signal that we're going to price it at least $20. And then to your point, CJ, it's as much art as it is anything. We could have offered it or we could have sold all the shares at 21, maybe higher, who knows? But we felt like there were a couple investors who had a lot of interest at $20 who we really wanted because we knew that they would be long-term investors and good patient money. And so we ended up pricing at 20. And, nobody knows, of course, what the first day pop is. I mean, I think we felt like we priced in a way that, that it would open higher than we had priced at, but like we had no idea, was it going to be $22, $25? I don't think we felt like it was going to be, much higher than 26. But we were really, really pleased that there was that much interest and that was our opening price.
Is there like a range that's not too hot, not too cold? Like you want it maybe above 10%, but under 50, or is it all just, it's in the eye of the beholder?
Yeah. I mean, I'm sure some banker would tell you that there's, that there's some sweet spot. I mean, of course, I think, it's certainly higher than 10. And, I think people would feel like at 50, it probably was more than they had expected. I feel like we were pretty close to what we had hoped, maybe a little bit on the higher end of what we had hoped for. But yeah, I mean, that's as much art as it is science.
How did you go about building the book for investors? So it sounds like T Rowe, you penciled them in on the cover. How else did you go about it?
Just one thing in terms of the preparation. Sure. We had done, I mean, as you know, I led investor relations at Microsoft, 10 years ago. And so even from the start of when I took this job, I spent a lot of time doing investor education. We did a fundraising round back in 2021 where we had met with some investors. And then I participated in some of the conferences, not all the conferences, but some of them. There's a question among a number of CFOs, like how many conferences should I do? And I basically did like one a quarter. Where I would go. I mean, each of the banks kind of has a rotation where they've got one, and people would call me and they'd want to come, they'd want to talk, or they'd want to do, you can certainly do meetings by Zoom. And so I think, as I mentioned, we did a lot of education over a long period of time. And so the ones that had done the most work, the ones who had dug in, in many cases, they had done, they'd gone out and reached out to customers, or they had talked to partners, and in some cases they came to our user conference. Those were the ones that we wanted to allocate to because they had done the work. And I, look, long only mutual funds or sovereign wealth funds or hedge funds, like any of them can do work, or any of them can, be lazy. I think we really wanted to build the book with the ones who had done a lot of work, who really knew our company, who we felt, we felt would be long-term investors. Now, I would tell you, if she listens to this, she's going to be mad at me. But my IR person is like, one of the big long onlys, big fund that y'all know, sold out in September, and she was super mad about it because, they had said, oh yeah, we're going to be in it for the long run, but the stock had gone up 50% since the time that they had bought it, and you kind of can't blame them, right? They made 50% on their money in like less than a quarter, but I wouldn't get fussed about that. People's, their job is to make money, and your job is to hopefully build a company that's going to drive long-term shareholder value. And if those two things converge, then that's great. If they say, hey, thank you very much, we made a bunch of money, then good for them.
Hey, thanks for listening. We'll be right back after a word from our sponsors. As a CFO, I can say firsthand that the most important thing to know is how money enters and leaves the building. Full stop. Without a simple and easy to monitor financial system, you're flying blind. And I'm the kind of guy who likes to have all my tools in one place. I'm talking checking accounts, bill pay, credit cards, and everything else I need to run a business. I'm pumped that Mercury is both a sponsor of this podcast and a safe place to keep my cash. It sure beats keeping my cash under my mattress again. Plus, it looks slick. I always get angry when back office tools are ugly. Newsflash. Finance people may wear both a belt and suspenders to work, but we like stuff that looks good too. Sorry, I just had to get that off my chest. Mercury simplifies your financial operations with powerful banking, giving you greater control, precision, and speed so you can operate at your best. Make the switch today, like I did. Tell them your boy CJ from Run the Numbers sent you. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group and Evolve Banking Trust. Members FDIC. What does the future hold for business? Ask 9 experts and you'll get 10 answers. Bull market, bear market. Rates will rise, rates will fall. Can someone please just invent a crystal ball already? Until then, over 40,000 businesses have future-proofed their companies with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control you need to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. Whether you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. If you listen to this podcast, you'll know I ask CFOs all the time to rep their tech stacks, and I would say almost every one of them use NetSuite. And that's what I would use too. Whether you're a company earning millions or even hundreds of millions, NetSuite helps you respond to immediate challenges and seize your biggest opportunities. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/metrics. The guide is free to you. That is netsuite.com/metrics. Ooh, yeah, it's netsuite.com/metrics. Please, guys, I really need this. Being an operator is not for the faint of heart. It often feels like you're jumping out of an airplane and building the parachute on your way down. CEOs, CFOs, COOs, and BizOps leaders feel my pain. That's why I joined Operators Guild. It's home to more than 1,000 of the most elite, high-growth operators in the world. Think the Special Forces for business scale. Members have access to over 150 in-person events across all 25 global chapters. The modern startup founder, CFO, and COO are really just multidisciplinary problem solvers, which is why having the best problem solvers together has created the ultimate diversity intelligence of any operator group in the world. Operators Guild gave me the chance to meet my own personal board of directors, people I can bounce ideas off of, and their online forum allows you to get answers from your peers as questions pop up. Like, how do I run an employee secondary? Or what should I pay as a base commission rate on SaaS deals? I've made great friends through attending their highly acclaimed OG Summit, and frequently attend their online masterclasses taught by the best tech operators in the business. Join Operators Guild and access the Navy SEALs of high-growth business scaling, a group built by operators for operators. Learn more and apply at operators-guild.com. That's operators-guild.com, and tell them CJ sent you. They'll hook you up. Yeah, you were a victim of your own success there, Bill. You turned out the top. But all investors, I feel like, want to tell you that they're long only. But if everyone was long only, you'd have no float, and that wouldn't be healthy for the stock either.
So what happens, back to your book building process, is you definitely need to allocate to some investors who are gonna basically flip you. You have to decide, again, along with the bankers, this is a bit of a source of discussion, sometimes tension.
Yeah.
In terms of, who those are going to be. These are obviously people who are going to make some good short-term money. And, we had some people that created liquidity who made some easy short-term money. And like I said, good for them, but we needed the liquidity to get the stock moving. And, that happened for sure. But you can't not do that, because then you're going to create a bunch of supply-demand disequilibrium, and that's not going to be healthy for your stock either. So again, you learn a lot through this process. I learned a ton, CJ, through this process, and and I had never done an IPO before, so you're just trying to figure it out. You've got a lot of really great advisors along the way, whether it's bankers or lawyers or other people, other CFOs who will call a friend and say, hey, I have this situation, can you help me? And there are some other CFOs who've gone through this process, and I've found that they've all been really great at giving me their time and their advice.
Speaking about learning, what matters the most in IPO prep?
I think you have to be agile. Nothing's ever going to go perfect. You have so many decisions to make in such a with limited information in such a little amount of time. And so if you get super stressed about it, I think that's going to be hard for you. I think if you can, just go with it, make the best decision that you can. Again, call experts if you need to. I ended up having a great law firm and great bankers and great advisors, great board. And so that helped a lot, but you can't get, if you get stressed about everything, you're going to drive yourself crazy.
I guess a different way to ask the question, what aged you the most? There's this famous photo of Barack Obama on his first day of office and then his last day of office. Did you feel like that coming out of the roadshow?
Well, the nice thing for me is I had no hair starting the roadshow or ending the roadshow, so I was in good shape. You know, as I mentioned earlier in the show, you know, we had so many things go crazy wrong, and I think we had a guy from Morgan Stanley who traveled with us the whole time, who was this Italian guy, and he just had this great, you know, joie de vivre that was always like, you know, he spoke Italian, and he just really kept you going, and I think that was really fun, but we were exhausted. I mean, we went, just to give you perspective, so our company's based here in Michigan. We went from Detroit to New York. You stay overnight. The next morning you kick it off. Well, you have to file your prospectus, and there were some changes that one of our investors made that literally kept the lawyers up all night, making changes to the prospectus, and a bunch of math. I will say one learning is that the lawyers are actually doing a lot of math and actually quite good at it. So then what happened is you basically launch by doing a presentation to the sales teams at all your syndicate. And then you basically like go. We were in New York all day. We ended up getting on a flight. We had dinner on the plane on our way to Baltimore. Of course, day 2, we were down in Baltimore with T Rowe and Brown and a number of other Durable, which is down kind of closer to DC. We ended up flying from there to Boston, of course, meeting with all the Fidelities and the Wellingtons and the like MFS in Boston. And then we went back to New York, and then we went from New York to San Francisco. Oh, in addition to the fact that we arrived in San Francisco, there was no food on the plane when we got on it to go to San Francisco, and that was going to be bad. So we ordered pizza from like some pizza joint near the airport when we were taking off, and somebody went and got it and brought it back. But we did all in person. I know one of your questions was, did we do all in-person meetings? We did all in-person meetings. We went to San Francisco. We met with the San Francisco firms. And then on Friday night, again, fortunately, we had a private jet from San Francisco and back. But otherwise, Delta, of course, had shut down, with the CrowdStrike incident. So we got back to Detroit. I was a zombie. Like, I think we got back at 2 or 3 in the morning, a zombie on Saturday, tried to recover. Sunday, we get back. We traveled with a bunch of other people from OneStream as well. We go back to New York. We did another day and a half, and then you price on Tuesday night. So that's when you kind of get the board, you get everybody together to try to decide, okay, as I mentioned, we were 17 to 19, like at what do you price it at? One of the things that's like, again, a learning for hopefully somebody that listens to this will take this, but literally the press knew the price we were going to launch at before we even walked out of the room. And so somebody had texted, or like, I don't know who it was, but somebody had texted a reporter because, it was like I was getting a news flash that said OneStream priced at $20, like before we even left that room.
That's wild.
And so friends and family start kind of coming into town. And obviously Wednesday was the day that we rang the bell, and, you're a bit in a blur. And then we of course we had a bit of a party the night of the IPO, and then on Thursday, you get back to work and go try to recover from how exhausting the roadshow is. Quite exhausting.
Did you have any music playing on the jet when you were going from place to place? Was there an album in rotation?
There was. So we had this awesome pilot. We didn't have any music on ourselves, but we had this awesome pilot. We were landing in New York, and he put it was this massive thunderstorm. And literally I was like, are we going to die? But you can see these like lightning strikes. I mean, I think Newark had been shut down, but we were landing, at one of the private airfields. And then he ended up sending me the video of the lightning storm set to like some rap music that was, and I still have it on my phone. It's just a reminder of like, wow, that was an insane experience. I'm glad we survived.
That's pretty metal. Well, from private jets to talk about metrics, how's that for a transition? Me and you were kicking around the idea of which metrics you release to the public on a regular basis. Two metrics that I noticed that you have out there are ARR and net dollar retention. Would you mind just touching on your mindset of why you want to release those and also how often?
Yeah, I mean, ARR is a really important metric to us. Obviously, as a SaaS company, and as you articulate, quite often in your reporting, it's arguably, it's one of the metrics that I actually get compensated on as kind of what our net new ARR is, and it's it's a pretty valuable kind of leading indicator to what our performance is going to be over time. We did do in the S1, we gave kind of ARR by quarter for the past couple of years. In our testing the waters and in our roadshow material, we talked about ARR. I told Wall Street that we would give ARR once a year going forward. And candidly, the reason is not that I don't like it as a metric. Obviously, I do, but our gross retention is 98%. And so if I give ARR by quarter, then basically I'm telling people what my bookings are. And I think every CFO would shy. I could feel the cringing from the audience of saying, like, I don't want to do that.
Yeah, they're like, anything but bookings, please. Don't make me do it.
And so I agreed with people that we would give it once a year. It's a pretty good, it'll be a pretty good indicator of what, our next year's performance is going to be. It's a really important metric to us. We told the street that we'd give it once a year. And then on NRR, I kind of say the same thing. Like NRR is a bit of a volatile metric.
Yeah.
I think in our roadshow materials, we told people that it averaged like right around 116, and then we ended up having a good Q1 with a big upsell to kick it up to 118. But similarly, we told people that we would give it to them once a year. Again, what we do, which is another interesting metric for people to think about, we do give of our bookings what percent is new and what percent is upsell. And, transparently, it's been, kind of north of 60%. And we've told people that on earnings calls. But I think that's kind of the way that we think about it more than kind of what's an NRR metric per se, because our balance, we want to kind of keep a balance of new at about, call it 2/3 and upsell as 1/3.
Is there a retention metric that you think is a better North Star?
I mean, we love gross retention. I mean, that's, I think it's the most important metric for a SaaS company. If you can keep, again, ours is 98%. If you can keep your customers, then it means you don't have to end up going and, it's always the thing, whenever any of us watches an airline commercial, you're like, wow, if you just tried to keep your existing customers more and then you don't have to go recruit new ones. But, which is, of course, what they've done with loyalty programs. But the most important thing for us is gross retention. It's a real cultural attribute for us that, our 98% gross retention. We actually named our IPO project Readiness because, it was all about, customer love. And we feel like that's the most important metric for any company. It's always easier to keep your customers. It's always better to keep your customers and go try to get new ones.
You're the first who's ever linked Greek mythology and gross retention on this show. And I'm going to remember that moment forever. Thank you for that, Bill. So I'm catching you a few months later, right? Well, what have you learned since? Public company CFO.
It's, your employees watch your stock price every day. I guess that's something that I knew going into the process. It's something that I wouldn't say it's a learning per se, but it's a...
Do you see them checking on their phone in the office when you walk by sometimes?
Oh, sure. Yeah. I mean, it's, our investors check it. We've got a large private equity investor, who reports their investment in us. And obviously this was the first quarter that KKR reported their gain in OneStream. And so there's a lot of attention on the stock price. What I would also say is all you can do as a CFO is manage your business. You can't really the stock price is going to be what people want to pay for the stock. And sometimes that's more than you expect. And sometimes it's less than you expect. But the reality is that as a CFO, your best use of time is to run your company and try to grow business. And so that to me, interestingly enough, has been a little bit of the, I wouldn't say learnings, but a little bit reinforced as we've gone public. Because of course, everybody tells you, hey, yeah, by the way, everybody's going to check their stock price. And you're like, no, everybody's going to be focused on growing the business. But like everybody checks their stock price.
Do you feel that there's a pull more or less so for your time to be external facing than before?
I had spent so much time leading up to the IPO.
That's what I figured.
And you don't like worry so much about, blackout periods or open windows and the like. We just as a reminder for the group, like right after you go public, you're in a blackout period. We had a short window where we released earnings, and then we had 2 weeks, and then we're in a blackout period again, and then we'll release earnings, I think, in a week and a half or so again. But so you've got these windows that you don't get to go engage with investors, which is both, in some ways it's good.
Yeah, a bit of a break. I never thought about like the blackout period actually being something welcome, right? It's like, some quiet. It reminds me of like back in the day when they didn't have Wi-Fi on planes, and you'd get on the plane after a long business trip, like, no emails can be sent to me, or no one can contact me and ruin my day right now.
100%. Yeah, you're right. Sometimes I get on those planes and you're like freaking out that for whatever reason don't have Wi-Fi, and sometimes you're like, yeah, same thing. It's like, wow, I'm so happy I can't get bugged. I could just
kind of a relief. Yeah. We touched on investor relations, and you worked at Microsoft and you spent time in their investor relations department, and they're now known for having one of the best IR functions globally. What tips or tricks did you add to your toolkit while you were doing your tour of service there?
So first of all, when Chris Liddell, who was the CFO at Microsoft at the time, appointed me or hired me to do the IR job, it was either late September, early October of 2008. Lehman Brothers had failed. And by the way, I'm not a Wall Street, I didn't grow up on Wall Street. Yeah. I'm just a CPA, and I didn't know anything about investor relations. And so all of a sudden I'd been poured into the fire, and I told Chris, I have no idea what I'm doing. And he said, and by the way, I'm the head of IR for the world's largest software company. But he was such a good mentor and such a good coach for me. He, ended up teaching me what to do. I think that what the screen was read for 4 or 5 months, every day through that process. I think ultimately we ended up hitting bottom in March of that year. And, it's a little bit trial by fire. And of course, Steve Ballmer was the CEO, and, Steve was a super fascinating guy to work with, which is also, a blessing. But I had more fun doing that job. It was hard. It was really hard, but it was also super fun to be, in such a high profile company that I wouldn't have traded it for the world.
I mean, you got to tell a story that is just an amazing one. Even if the macro environment is really poor, you're doing it at a company that has such history and is doing innovative things.
Yeah, but remember, CJ, I was there when the stock price was flat for 4 years. So
4 years, wow.
It only, and candidly, it had been flat for 4 or 5 years before I got there. It was the time, talk about metrics, revenue and earnings for Microsoft were going like this, but the stock price was dead flat. The multiple was just compressing because people, Microsoft in investors' minds missed the mobile phenomenon. Obviously, I was there when the iPhone had just come out in 2007. So I was there obviously in the infancy of that. The iPad came out, and Microsoft is spending a lot of money in Bing, and so it was a hard fight for sure in that job. But like I said, I learned a ton. Steve was incredible. Obviously, that was the birth of Azure, which of course is the driver of their shareholder value today. But when you're in it during that process, it's a hard job, but it was it was super fun.
What is Steve's energy like? Is it just like you see courtside?
Off the charts.
Yeah.
I mean, he's he's a math major as well, so he's like wicked smart, super high energy. I mean, you've got to have your A game on all the time working with Steve, and like I said, I learned a lot working with him for sure.
You also were the CFO of Microsoft's Skype division. That was a high profile acquisition.
That job was really fun. The culture at Skype was incredible. If you recall, pre-Zoom, pre-Teams, pre-WebEx, like Skype was how people communicated with each other globally. And so I traveled for those of you who don't, like Skype was originally kind of founded in Sweden, although most of the engineering team was in Estonia. The operations center was in Luxembourg. So I had people, and then we had a lot of our engineering team was in London. And then of course the headquarters was in Palo Alto. And so I traveled a lot. And the thing that was insane was I would there could be a line of 500 people behind me. And the person at customs or immigration or wherever who would ask you, like, what do you do? And I'd say I'm the CFO for Skype, would inevitably tell me some story about how he or she was able to talk to their grandchildren when they, who lived, in a different country or miles away. And the stories that people told about how impactful Skype was on their life was unbelievable. And so as a CFO, you feel you have a responsibility to continue to provide those services to those people because, it was so impactful in their lives. And so it was a really rewarding job. We had a fantastic team. Tony Bates was the CEO. Of course, I think they announced that Genesis had confidentially filed their S1 the other day. And so I'm really excited for Tony for that. And so some of the other team members have gone on to have really great jobs and great careers as well. And so it was a great product. It was a great experience and it was a great team. And like, what's better than that?
Yeah. Was Microsoft, had they fully flipped the switch to go to SaaS at that time, or were they still playing the perpetual world?
So for Skype, the largest monetization, if you recall back to that time, their largest monetization was really on telephone calls.
Yeah.
So in the past, if you wanted to call country to country, you had to pay, very high international telephone rates. And what Skype would do is it basically became an opportunity for you to go up from whatever your local telephone provider was up to the internet, cross over the borders, and then drop down into a local telephone provider. And so Skype could do it substantially cheaper.
Right.
And so it was about $800 million of revenue from that.
Wow.
And then the other thing that they had to do, which is what Teams is today, is Skype was peer-to-peer networking. And so, like Napster, of course. And so, but in a mobile world, you couldn't have like 500 friends pinging your phone all the time because your phone battery would die in, 20 minutes. And so we had to re-platform Skype, which is now, what the platform that Teams runs on, which is we had to make it so that there was a cloud first environment. And, and that involved a lot of engineering. And then back to your point, Microsoft was in the process of transitioning to Office 365. They rebranded Skype for Business as Teams. And so now it's all part of their ELA.
Wow, that's amazing. I didn't know that Skype was the backbone of Teams. So thanks for breaking that down. This is a history lesson as well. I appreciate this.
Sorry, CJ, I'm old. You're exposing my age.
If you reflect back, speaking of age, but we'll look at this as knowledge, not age. What were the hardest or most critical moments on your path to CFO?
So back in 2000, I was the CFO of a company in the Bay Area that we ended up closing. It was hard. I mean, we had to lay off, 250 people. That they had raised a bunch of money. It was called carclub.com for background. But I learned a lot of lessons there that first of all, capital markets matter. I guess that's lesson number one. But, a lot about transparency. If you don't trust your employees, they won't trust you is a really important, mantra. Everybody was fighting until the very end at that company. I was super transparent with vendors. who we owed money to, and we never ended up getting pushed into bankruptcy because we were able to pay people out more because we closed out of bankruptcy, and it was a hard process. One that I'd say was super transformative in my life, in my career, is being one that transparency matters, and yeah, I mean that informed a lot of things that make me who I am today.
This may be an odd question. Do you think delivering bad news or picking up the phone to call investors when it's maybe not a favorable outcome gets any better as you go through your career, or is it always going to be that hard?
And look, I think you learn that it's better. Bad news never gets better with time.
Okay.
And so I think what happens, I don't know that it gets easier.
Yeah.
Ever. But I think you get more experience that's the right thing to do. I mean, look, I'd say the same thing about if you ever have to terminate people. Like, it's not super fun. It's never fun to terminate people, but I think my experience has turned into, it's better. Sometimes people, I know this wasn't part of your question, but I'd say the same thing.
It all is.
You have to make hard decisions. And in some cases, those decisions lead to better outcomes for you and for the other people involved. And I've seen more cases where, somebody was in a bad situation and they ended up getting in a good situation, and they kind of come back and say, thank you. Not that that's an awesome thing to do, but, sometimes it's the right thing to do.
Yeah. Yeah. And you've seen what great looks like, both at scale and on the smaller side at startups. What qualities do you think separate the good CFOs from the great ones?
I think we hit on a lot of those, CJ. I think you need to be honest. I think honesty always is the most, honesty and integrity is like, kind of a given for good CFOs. I think you need to work on being transparent, being as transparent as you can be with people. Obviously, as a public company, in a public company role, you can't be always as transparent as maybe investors would like you to be. But it kind of goes side by side. I think you need to have a tenacity that, I'm not going to say a Steve Ballmer tenacity, because of course that would be unparalleled. But look, stuff's not going to go right all the time. The resilience and the tenacity, I think, are the things that that are super important in life, and you just got to pick yourself up and you got to keep going. And I think that matters. There's another person, if anybody on the call knows, Kelly Breslin was the woman who ran sales for Tableau, and Kelly sold books door to door and was to this day still the most successful door to door salesperson. And the story that she tells is like, somebody slams the door in your face, the person at the next door doesn't care. You got to just keep going. And I remember that story, and her her tenacity and tenaciousness are things that kind of keep me going as well.
That's a great one. Bill, I'm going to take you into what we call our long ass lightning round. So you're a successful guy, but I ask every CFO, what's something you've screwed up in your career? Could be this job or a different one.
Yeah, I think sometimes where I haven't been as transparent, as fast, delivering the bad news as fast as I need to. It is, stewed a little bit longer than I had wanted. Transparently, when the interest rates were going up 3 years ago, it wasn't awesome. I think probably many of the CFOs here had maybe some short-term bonds in their portfolio, and I wish that I hadn't had that happen. Obviously, there's some banks that were impacted more than I was, but yeah, I wish. I just think, back to my point on good news doesn't get better with time. I think you just got to be transparent with people and say, like, hey, I'm in a tough situation. Any advice?
That's a great one. And reaching out to advice, I think, like, it's funny. You would think it would get harder to reach out for advice the more you know, but I feel like everyone I talk to on the podcast, the higher they've climbed in their career, they pride themselves on being able to reach out to people and say, hey, I don't know this.
Look, I think asking for help is one of the biggest skills that you can have. If you feel like you know everything, then there's nobody that knows everything. And so I think, find a good network of people that you can ask for help. And I'm fortunate that my board is there, and I have a lot of friends, obviously, and other CFO roles that I ask for help as well.
Speaking of asking for help, if your younger self called you and said, Bill, tell me something that I need to know for the future, knowing what you know today, what would you tell them?
I think many people start their career and they think that they have to have a path. I started my career in public accounting and, it was like, you have to follow this path or that I should have this journey, or somebody tells you like you need to have a plan. I would tell you like, do what your heart tells you to go do. Sometimes it's really painful. Like I've had some roles that, I think we talked about one of my other roles where I was the CFO of Blue Nile. Candidly, it was my wife's favorite of my jobs.
I don't blame her. Yeah.
At a jewelry company. But like, I started there and the Google algorithms that we had relied on for basically SEO or kind of free search had changed right before I got there. And, all of a sudden our traffic was down 30% year over year. And you're like, oh, darn, like, what do we do? You just, you gotta like live for the intellectual challenge of what you're doing. And sometimes that's financially rewarding and sometimes it's not. But if you just follow money, that's not the right outcome. You should follow the things that are intellectually challenging, the people that you want to work with, and, just have fun with your job every day.
And I bet there are a lot of people out there listening to the podcast who say, oh, well, I could flip to this industry or that sector. And it's maybe something they really don't care about. And they'll do it for the money. But it sounds like that's never the most fulfilling path.
It's not. I would say do what you love. Do what's intellectually challenging and do what you love. Yeah. And candidly, like people that you want to work with. I think that matters a lot.
Yeah. More of a technical question. Can you walk me through your finance software stack? I have a feeling I know where this one might be going, but what tools does your team use today to get the job done?
Well, I'm going to actually give you a little bit about where we started. We were using, I'm going to give you like more than just finance. So we were using QuickBooks. We were about 40 million in ARR at the time.
I wanted to ask you, but I didn't know if you'd give me that answer. So you were using it up to 40 million, which is great to know.
And we were using like Bamboo HR, I think, for our HR tools. And we had just implemented Salesforce for our CRM. And then we had just done a professional services, I can't remember the name of it, implementation as well. So we've migrated a great deal of our tools. We're using UKG for HR now. We migrated to Sage Intacct for our ERP system. And I hired a controller who had been a customer actually here in Michigan of OneStream. And she loved our software. Again, there's a theme. And she said, hey, I want to come be the controller. She didn't know software accounting, but she'd worked at EY earlier in her career. And she did an incredible job of implementing OneStream for, we started with closing consolidation and obviously, then included planning. And now we're using it for AI and a bunch of leading capabilities, as you can imagine, trying to, eat our own dog food. The other thing I would say is I hired the head of FP&A who had previously been at DocuSign, and JD has been incredible. And he brought a bunch of people from his team over to lead FP&A for us. And so we, we're our first and best customer. It's fun to do that. The other thing that's actually really super fun about my job is, my peers are our customers. And so, I go to the JP Morgan CFO conference or the Goldman Sachs CFO conference, and, inevitably, we tend to, our core customer tends to be the enterprise or kind of mid-market and up. And, I'm pretty excited that, I've got a lot of happy customers. And so that's been great for us.
I always thought it must be cool to be a CFO of a CFO's product.
It's like a dream job, honestly, because you get to use your own product.
Do they ever make you do like marketing videos or anything?
So Pam, who's our controller, has done a lot more of those. She tends to be more involved in the, kind of day-to-day use of the, of the software than I am. And she's a better speaker than I am. So Pam's been great.
They wouldn't put my face on a billboard. All right. Last one I got for you. What's the craziest thing you've ever had someone try to expense?
I was thinking back on that. There was a raincoat that somebody tried to expense because they were in London. and it was raining. So they said, hey, I had to go buy a new raincoat because it was raining. And it was like a super expensive one, like a Burberry raincoat. I'm like, really? You had to go? It wasn't like just some like cheap raincoat, but it was like a Burberry raincoat that somebody was like $600 or maybe even more. I think it was $600 at the time, but I still remember that one. I'm sure other people have expensed stupider stuff than that, but that was the one that kind of sticks out of my mind because I literally called them. I'm like, really? You need a $600 raincoat?
It was raining really hard.
And apparently they needed to look good.
Bill, this has been one of the most fun podcasts I've recorded of the more than 100 so far. So thanks so much for being generous with your time.
Well, thank you. And I appreciate everybody listening.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.